Joining me now is Pam Villarreal with the National Center for Policy Analysis. Thanks for coming in.
Thanks for having me.
The volatile market, the drop in the country's credit rating, a lot of people are worried about their IRAs and their 401ks. What do you tell them?
Well, the worst thing you can do right now is to panic. Often what happens when we get these volatile weeks in a market, people look at their 401ks, they start moving money out. And essentially if you're in stocks or equities and the prices drop, then you're locking in your losses because you've bought those equities at a high price and sold them at a low. So the best thing to do right now is to sit tight because this is not going to last.
Okay, let's talk about bonds for a minute. It's a complicated subject, but an important one. Can you simplify it for us?
Sure. Basically, when you buy bonds, you're buying, you're lending money to the government or to a corporation, and they have to pay you interest on that. So when you buy a government bond, you're buying government debt. And the Federal Reserve sets the interest rate for the bonds, but then they kind of set this target, so they will buy and sell bonds depending on the demand and supply for them. So that kind of keeps the interest rate where they want it to be right now, which is between 0 and 0.25%.
Let's talk about if you're 64 years old, if you were just about to retire, you've taken a significant hit. What do you do?
I think the most important thing right now would be to not do anything. What often happens is when people are especially very close to retiring, they start moving money around. They make kind of a rash decision. I think it's better if you're going to retire in the next year or two when you do retire, to perhaps move some money around at that point. But then you're not going to be taking all your 401k out to live on. You have to remember, even if you're 64, 65, you're still a long-term investor. You could live to be 100. So you have to treat your investments like that. Even though it's very tempting to want to do something now, it's better to wait.
With interest rates coming down, do you buy a house now or wait a little bit longer?
I think right now the housing market is still good. The interest rates aren't going to change. The housing market, there's some great deals on houses. I think if you have the money and you can afford it, buying a house now is a great idea.
And what about people who have put their money in their homes as an investment? How does it affect those people?
It should not affect them that much. Really, what is affecting that is the recession. So if you're in a home and you plan on staying in it a while, you don't really have a lot to worry about. If you're planning on retiring on a profit from your home, you may have something to be concerned about, but that really wasn't a result of this week's events. That has been a result of the past few years.
We asked some of our Twitter followers to submit questions, and we got this one. This Morning Year asks, will the credit rating affect my student loans? Good question.
Well, the thing about the credit rating, since the Federal Reserve is not changing interest rates, then the borrowing should generally not be affected. The interest rate should be the same. And we have to bear in mind that there was only one credit agency that downgraded us. There's two others that have not downgraded us yet. So, I mean, this is a significant indicator that we need to exercise some fiscal restraint. But really, borrowing in general should not generally be affected.
All righty. Thanks for the good
thank
answers. You simplified it all. Thanks very much for coming in.